Okay, good morning and welcome back everyone to our options education market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and markets are continuing to be in a very choppy sideways action. So today we want to take a look at what our views are with the broader equity markets, fixed income markets, as well as some subsectors and in different ideas. Now, before we get started, what we are going to discuss here today is purely for education or demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss during today's session. So we'll cover the equity indices first, take a look at where the major indices are moving, and taking a look specifically at market breadth and what that potentially could tell us as far as the outlook of the overall markets. Then we'll take a look at the fixed income markets, which I would say largely have driven equity outlooks, if you will, over the past few weeks and kind of what changes we've seen there. We'll take a look at commodities as well as the sector rotation model, which sectors are strengthening, which sectors are weakening. We'll take a look at a couple of subsectors that are currently at risk before taking a look at our bullish and bearish market movers for today. So when we start off by taking a look at the S&P 500, what we see here is a very clear uptrend of the S&P 500. Now, when we look at this uptrend, what has been recently challenged has been the short-term moving average here. It has broken below it and recently was rejected at that level here again. And if we look at the daily chart here, what we have here is multiple rejections here at the 21 and 50-day moving averages. But I will say, no, we still have some support coming in here around 428 or so. And I think for now, our primary view here for equities is more of a sideways action here. We don't have that acceleration here to the downside. We've had this support level 428 hold multiple times. So even if we see some further downside, our expectation is that it would likely hold at that level and bounce higher. And we really want to see the S&P 500 break back above 440, break out above the recent highs here, in order for this to continue a bullish trend. But until that happens, we're more in a very neutral tone. And if we look at the NASDAQ 100, the NASDAQ 100 looks a little weaker than the S&P. It's recently broken below this 360 level here or so. But again, there's some strong support here around 352 that's coming in here for the NASDAQ 100. So if we expect more sideways action here for the NASDAQ 100 here as well, until it breaks out above 365, 366 or so to the upside, then we could potentially continue more bullish trends here for the NASDAQ 100. And if we look at the IWM, the Russell 2000, it continues to trade into this apex or triangle, and this is a potential breakout opportunity. Now we're not quite there at the apex yet, but this is one that's been in this apex for almost 9 months now, and this is one that we would expect to see a huge breakout one way or another. We just don't quite have that breakout yet, and we'll have to see where things go. But small caps, one of the I would say bright spots here in the equity markets is the fact that small caps have held and continue to make lower highs, while the S&P and the NASDAQ 100 have started to make lower lows. And this is really what is somewhat encouraging about the market breadth that we're seeing in the equity markets here today. And this is especially true when we look at the equal weight S&P 500. What we see with the equal weight S&P 500 is that it continues to make higher lows. So this is really something that's quite encouraging, that the broad market is not selling off as the S&P and the NASDAQ remain fairly weak over the past few days. So what this really tells us is that the performance declines that we've seen here in the equity markets have largely been concentrated in those higher beta, higher mega cap tech names. Those are the names that are dragging the major indices higher, because the S&P and the NASDAQ are heavily weighted towards those mega cap names. But the rest of the market, when we look at RSP, where every single one of the S&P 500 names has an equal weight, it's not selling off. It's actually not anywhere near previous lows. It's not far off from previous highs either. So the RSP is starting to show us that, the sell-off here is losing some momentum. And one of the big breaks here, or one of the big, I would say, causes for the market losing that momentum has been TLT. If we look at the bond market has been particularly weak, breaking below the 146 level here for TLT as it continues to move lower. This has been a concern here, especially after this double top high here on bonds. Our expectation is that bonds will likely trade back down into the 135 levels here, but it's starting to lose a little bit of momentum here. As you can see, we've made a lower low, but we did not make a new lower low on momentum. So this is one that we expect to see a little bit more choppy, perhaps back into the 144 before it starts to move further lower here. This is not one that we necessarily expect will just continue moving lower like this, because the sell-off is losing some momentum here to the downside. When we look at the bond markets here, what we see here, when we look at yields, we see this approaching 165 basis points, which is largely the equilibrium that we were trading in for months prior to yields declining here during the summer or so. So we're back towards the equilibrium price that we were around in terms of yields since the beginning of the year. So this is one that, if you put that into context, markets didn't sell off when we were at 160, 170 basis points previously. So our expectation is that markets are not going to sell off at these yields. The yields would have to move above 175 basis points for markets to get a little bit more jittery and see some more pullbacks here in the equity markets. So those are some of the more encouraging signs that we see here for equities. We do see dollar continuing to break out higher here. The dollar managed to break out above the $93 resistance level here on the longer term chart. It does have some resistance coming in here around 194 or so. A breakout here above 94 would certainly be far more bullish here for the dollar, and that's going to put some further pressure here on some commodities like gold, which have already been under pressure here for many months. As you can see, while gold has been very choppy, it remains in this strong bearish trend. And we do not have any evidence yet of gold breaking this bearish trend. So my expectation here is that gold will likely continue to trade fairly choppy, but continue to trend to the lower side. So every time we see gold kind of trade near the top end of the channel, that's where I would look for, potentially bearish opportunities. As it gets toward the bottom of the channel, those are really kind of short-term bullish opportunities, but long term, my views here are more to the downside. And then when we look at crude, right? Crude broke out from what has been a major support or resistance level here around the $76, $77 level or so. And this is a level that has held for many, many years now as resistance, but has now been broken. So when we look at crude, the supply issues here in crude do not seem like they're going to resolve themselves anytime soon. The rally has taken a bit of a pause here over the past couple of days as there's been some consolidation, but long term, when you look at the fundamentals here, they still point us to what could be further upside here for energy prices. This is going to put pressure on not just crude, but also natural gas, coal. Those fossil fuel energy sources will likely remain constrained in terms of supply and likely see some further upside. Now, when we look at the sectors, and this is the watch list from the options play tool, you'll see that the sectors have improved a little bit here. Specifically from staples, we've seen the 6-month trend has turned neutral here for staples, and we've also seen consumer discretionary. The 6-month trend has turned back to bullish here. So a small improvement here across the board when we look at the overall sectors. As you can see, you have 5 sectors now have a long-term bearish trend versus 6 from last week, 3 with neutral and 3 with bullish this week versus 2 that were bullish last week. So things are starting to improve, and specifically if you look at industrials as well as materials, both of them last week had short-term bearish trends, and both of them have now turned neutral this week. So we continue to see a little bit of improvement here from the sectors data going into this particular week. So when we look at sector rotation, right now we have 7 sectors in the improving and leading category and only 4 more in the lagging and weakening. So we clearly see financials and energy have started to come down. These were the two big leading sectors, but we have seen industrials and staples start to show a little bit of leadership, while materials and utilities are continuing to strengthen here and gaining some momentum here. Communications started to reach that kind of improving category, but I'm concerned that it's going to actually come back into the lagging category. We'll take a look at the charts here for these to better understand, but consumer discretionary is really the one that has lost quite a bit of ground. Technology is trying to turn higher here, not quite there. Healthcare turning higher a little bit, and real estate starting to show a little bit of strengthening here towards that improving category. So when we dive into this, when we look at industrials certainly have started to look a little bit stronger after putting this double bottom here, but it also has put in a bit of a double top here. So our expectation is really for industrials and materials to be a little bit more neutral, especially since both the daily and weekly momentum has started to turn negative here. The rejection here, the 50-day moving average here yesterday was not particularly constructive, but we do expect that $98 support here will likely hold here on any further weakness here for both industrials and materials. Very similar chart here on both. But when we look at healthcare, this is really where things are a little bit more precarious. Healthcare, the long-term momentum at the moment has not turned negative here, so we could see a bounce from here, especially since when we look at the long-term moving average, this is a moving average that has held every time. And you can see we're approaching that moving average here. The only difference here is that we have had a crossover here. The short-term versus the long-term moving average has crossed the downside. That's not particularly strong here, but we are approaching some major support levels here around 124 or so. So we could very well see a bounce on the overall markets, especially as market breadth continues to improve. We see the same thing here for communications. We had the same moving average crossovers. Momentum remains positive here in the long-term chart, and we're approaching some major support levels here. So we're really watching to see if these levels can hold, because if these levels can hold on industrials, on communications, on healthcare, that's really where we have the opportunity for equity markets to start recovering and start showing some strength. But with all of these markets, they are precarious. They are at risk of further downside. And these are the major levels that we should pay attention to, because if we see communications break below the $79 level here, that's really where we are a bit more concerned about the broader markets, because this is telling us now the rest of the market is starting to sell off here, and that could be some concerns here for equities. When we look at financials, what was interesting here is that financials at the end of last week attempted to break out above its all-time highs. But as of yesterday, what we have seen is really more of a triple top rejection. So interest rates taking a bit of a pause, has certainly been not particularly strong here for finance, or has been a tailwind for financials. But despite the strong gains we've seen in yields, we have not seen financials move any higher, and that's not particularly strong here for this particular market. So when we look at financials, this triple top, in my opinion, is a concern that we're going to see more chop here until interest rates break out significantly higher from where we are at the moment. So when we look at some of the subsectors, one that is concerning to me and one that I think is worth watching here is SMH, semiconductors. Semiconductors, despite the chip shortages, attempted to break out higher above its major resistance level around 260 or so. And multiple attempts to break out higher here so far has failed, and we're back into the trading range here. And you can draw your trading ranges in a few different ways, but largely I think that this is kind of the trading range that we would be looking for. It may be a bit of a minor trading range here, but more likely that it could test all the way down to the 220 lows here. So this is one also worth paying attention to, because as we're approaching these minor support levels, we've got the moving average crossover. Momentum has turned negative here on the daily chart. It has not turned negative here on the longer term chart just yet, but it is at risk. And a pullback here below these support levels would potentially target 220, 225 here to the downside for semiconductors. So semiconductors relatively strong, showing some weakness here is a concern for me. And another one is retail. As you can see, retail has been extremely strong. Part of this gap higher here and the strength here has been on GameStop, because XRT is more of an equal weight index. And what you see here is that it's starting to approach these major support levels here again. And this is, again, one of the cases where moving averages have crossed over on the short-term chart. As you can see, momentum is clearly negative on both the short and long-term chart here. And it's approaching this major, moving average line that really hasn't been tested at all throughout this rally here. And the fact that we're now testing it is concerning. We haven't broken it yet, but we're just on the verge of it. And these are the ones that I think we really have to pay attention to, because if we see these bounce, that confirms kind of some of the firmness, if you will, that we start to see in equities. But if we see these break, then I think there's further downside here for equities at the moment. I think a lot of investors are trying to ask themselves the question right now: is this time to buy the dip? And we certainly seem to be approaching some of those levels that would be considered as opportunities to buy the dip. But the one thing I do want to point out here is that there's further downside opportunities if we see these major levels break, and we are kind of at that tipping point here at the very moment. So looking for some opportunities here in this market. I think we really have to look at, when we look at the economic indicators, when we look at what's improving in the markets, despite the poor jobs number, overall services and, leisure and hospitality remains relatively strong. The weakness in the job market that we saw here in last month have largely been due to the fact that the government has shed a lot of jobs. The private sector has actually been somewhat strong here. So when we look at, the breakout here of some of the kind of reopening stocks, Live Nation breaking out above this $92 all-time high, starting to see a little bit of a pullback here, potential opportunity here to the upside, especially on stocks that are, in this reopening category, and so far have been showing a lot of strength here going into the end of this year. Another one here is the airlines, and we do have to be careful now with the airlines, especially with the rising cost of fuel. We've seen Southwest Airlines earlier this week with respect to the canceled flights because of the lack of pilots. I think you're going to see the same type of concern across the airline industry. But when we look at some of the better run airlines, Delta Airlines certainly would be one in that category. And what we have is a breakout, a pullback to the breakout level, and just from a risk reward perspective would favor here to the upside as we look for more of that reopening trade opportunity here, looking at some of the airlines. And you have a lot of the similar type price action for many of the airlines, but I think focusing on some of the airlines with more international travel will likely be, in my opinion, some of the ones that are worth paying attention to, especially the ones that have a better financial position, such as Delta Airlines, are ones that I think are worth paying attention to. Another one, in the reopening trade is really the cruise lines. Norwegian cruise lines, having a bit of a breakout higher here a couple of weeks ago, came back to retest the breakout level here twice. And I simply think that just from a risk to reward perspective, you're going to favor moves potentially to the upside. This could be too early, if you will, on some of these cruise lines, but we have seen a fairly significant improvement in terms of the COVID cases and hospitalizations around the country and around the world. We certainly seem to have even some of the worst lockdown nations in the world starting to remove restrictions on travel. So overall, we're going to start to see, I think, travel ease quite a bit. And there's clearly a lot of pent-up demand for travel. So when we look at the cruise lines, that are fairly levered, when you see good news, these are the ones that are going to be very volatile, and you're going to see big moves here to the upside. So this is a bit of a long shot here, but these are the ones that I think have the chances of a big move to the upside, as we've seen here in the past. Big moves to the upside, even though these were all too early. As you can see, every time there's some kind of optimism around reopening, these are the ones that see a big pop here to the upside. So Norwegian Cruise Line's one that I would look at. Now, when we look at Charles Schwab, this is one of the financial institutions that actually have started to break out higher here during the financials. So this is outperforming the financials sector. This is one that I'm paying attention to, especially as they continue to integrate, TD Ameritrade into their company. This is one that I do expect in the long run will be able to benefit from the synergies between, the merger between Schwab and TD Ameritrade, the breakout to all-time highs, especially if we start to see interest rates continue to rise and the rate curve continue to steepen from here. That's when I think names like Charles Schwab are likely going to be net beneficiaries of that. And on the flip side, if we look at some opportunities here to the downside, I really think you have to look at some of these really lofty valuation type tech stocks like Team. This is a stock that continues to trade at richer and richer valuations. So not only is the stock at all-time highs from a price perspective, but also from valuations, it's pretty much near all-time highs. And this is in the face of, what is clearly earnings that have started to slow down here. We've seen earnings growth started to slow down. We've seen revenue growth started to slow down here. So this is really one that I think that has the potential of at least a bit of a check back here towards the 50-day moving average, which is around 360 or so. It's currently trading around 390 or so, about a $30 check back here to the long-term moving average. I think is reasonable to see, stocks where we're starting to see slowing momentum, not only from a technical perspective, but also from a fundamental perspective that have very, very high valuations. These are the ones that have the biggest pullback risk when we talk about higher interest rates. And then when we look at, some of the the consumer stocks, you have Starbucks. Starbucks has had a very strong run here to the upside over the past year or so, but it's broken what has been a major trend line here. Starbucks has been on a very strong trend line here, but we've recently broke below that trend line here. As you can see, not only have we broken that trend line, the moving averages have crossed over recently, and it broke below some support levels here. So minor support has been broken, came back to retest those levels as resistance, and so far has been rejected. And I cannot help but think that Starbucks has some further downside, especially since long-term and short-term momentum have both turned negative here. And then looking at the semis, as I showed you that risk here that I see here with the semis, same thing here with NVIDIA. NVIDIA attempting to break out higher here, but failed to that all-time highs. And what I simply think that is, I'm not bearish on NVIDIA. I just simply think that we're headed back into what has been more of a consolidation range, similar to what we saw here after what has been a very strong run up. You consolidate. We've had the similar type setup in terms of run. So we've reached our primary targets here to the upside, and now it's time for a consolidation. So NVIDIA simply, I think, is headed more for a sideways action, especially in this chip shortage world of the, of semiconductors. And lastly, I want to take a look at BlackRock. BlackRock, similar to the other financial institutions, what this is a little weaker. What we've seen here is BlackRock has recently broken below, some major support level here after breaking out higher here. We're starting to test these support levels here. Both the short-term and long-term momentum have turned negative. We've got the short-term moving average crossover. We're just at this longer-term moving average support here. If we break below this, there's some significant downside here for BlackRock. What has been one of the best performing asset managers here in the financial institution space, we're starting to see some further downside here, and some of the price indicators, the price action, as well as some of the momentum and trend indicators have started to show some weakness here. So I'm concerned that we could see some further pullbacks here in a name like BlackRock. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to how to navigate the current markets and what to look for here in the current market environments. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.